Hey everybody, I've been focusing on ETFs, exchange traded funds, index funds in particular, as a bigger part of my investment strategy in the past year or two. Um, I'm starting to get about, I'd say, like halfway through my investing lifetime, my accumulation portion of my lifetime anyway, which for most people runs from about 25 to 65. So I'm in my mid 40s right now. So I'm kind of shifting money from individual stocks into ETFs as I get a little bit older. There's kind of more of a set it and forget it mentality in my retirement accounts, especially. So we're going to talk about the latest ETF that is on my radar that I think I'm going to finally pull the trigger on. I've been watching it for a while, um, and I'm going to talk about it right now. But before I do, please take a minute and check out the link you see on your screen, fool.com/Frankel. The message from the Motley Fool, which is the sponsor of this video. You get the top 10 stocks to buy right now, and it is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel, and please stay tuned until the end of this video for a message from the Motley Fool. So I'm going to go ahead and share my screen and do the big reveal. And as you can see, the ETF that is on my radar is the Invesco Equal Weight S&P 500 ETF. For a while, I was building a position in the Vanguard S&P 500 ETF. Ticker symbol of that one is VOO. But one, I don't really love investing when the market's at an all-time high. Um, I just don't, especially when the all-time high has been fueled by just a few big companies. If it weren't for the so-called Magnificent Seven stocks like Nvidia, Apple, Microsoft, the market would not be at a record high. Those have really propelled it higher. So this one kind of lets me put my money to work in the large U.S. stocks without relying too much on those big companies. So the Invesco Equal Weight S&P 500 ETF, the ticker symbol is RSP. It has a 0.20% expense ratio. If you're not familiar with how these work, this means for every $1,000 you have invested in the fund, roughly $2 per year will go toward investment expenses. This isn't a fee you have to pay. It's just reflected in the performance of the fund over time. But it's always important to know, especially for the purpose of comparing these. I mentioned the Vanguard S&P 500 ETF. That has an expense ratio of just 0.03%. Now, as a general rule, the more specialized or unique an index fund is, the higher the expense ratio will be. I wouldn't call 0.2% a high expense ratio by any definition, but it's definitely higher than the basic S&P 500 index fund, so keep that in mind. And the big difference is this invests in all the same 500 components of the S&P 500, but it does so in equal amounts. So here's what I mean by that. If we look at a comparison between the Vanguard S&P 500 ETF, which I already own, and the Invesco Equal Weight, you can see the top holdings there. Apple accounts for 7% of the Vanguard S&P 500 ETF. So there's 500 stocks, and one of them accounts for 7% of the holdings. Microsoft is 6%, Nvidia is 5.8%, Alphabet or Google is 4.4%, and Amazon is 4.3%, just to name the top five. And if you look for the equal weight, just 0.2% in every company. It rebalances occasionally. So the percentages will vary a little bit from day to day. It doesn't rebalance constantly. But generally speaking, it invests 0.2% of its money, which is 100% divided by 500 in each of the 500 S&P components. So here's kind of why I'm doing this, my investment thesis. The S&P 500 is a very top-heavy index, and it has become more so in the past few years. The top 10 S&P 500 components make up 37% of the index's weight. That's almost 40% of the performance you're seeing in the S&P 500 is based on just 10 companies. The other 490 stocks make up 63% of the index. So for me, that's just a little too much reliance on a small group of stocks for an index fund. I don't like having any part of my portfolio accounting for more than 6 or 7% of my investments. And that's especially true for an ETF that I don't want to have to worry about. Because right now, if Nvidia or Apple or if big tech as a whole takes a big downturn, the standard S&P 500 is going to get crushed just because of its reliance on that. Meanwhile, with the equal weight, if, say, Nvidia has a terrible earnings report, it makes up 0.2% of the holding, so that single event isn't going to have a big impact. So It eliminates what is honestly my least favorite part about investing in the S&P. So the equal weight ETF, all companies have that 2.2% allocation. So just to name a couple, just to put this in perspective, this means like smaller companies that are in the S&P like Match Group and Dollar General have just as much influence on the ETF's performance as the larger players like Apple and Nvidia. So performance, let's talk about how this does. Look at what it's done in the past, because honestly, in the past, 20 years almost, the equal weight S&P has underperformed the standard S&P, and that is because of the big rise of these mega cap tech stocks. I said the S&P probably wouldn't be at a record high today if it weren't for those giant tech stocks, and that's really what's caused the outperformance. But over the really long run, it's a different story when you like get back into the early 2000s and the 90s and things like that. So if we look at this chart of the performance over time, you can see the past 3, 5, 10, 20 years, the equal weight index has done fine over 20 years. I don't think anyone would be that mad with a 600% total return from an investment that's pretty much set it and forget it. But it is a little bit lagging behind the general S&P 500. But if we look back beyond, so 20 years ago would be 2005. If we go back another 5 years to 2000, you can see that the equal weight is crushing the regular S&P 500. And same with if we go back 30 years, so that would be 1995. So through the dot-com bubble and all that, you could see just historically, and this is through today, so 1995 through today, the equal weight S&P 500 ETF has 240 percentage points of outperformance. It's lagged lately, but I do think that the big tech run is, I don't want to say out of steam, but one of my big predictions for 2025 is that big tech is going to lag behind the overall stock market. And if that's the case, then the equal weight should return to outperformance and kind of narrow this recent performance gap. So just to kind of sum it up, the equal weight S&P could be a great fit for you if you want broad exposure to large cap stocks without that big concentration in the mega cap tech companies. So even though the Invesco equal weight S&P 500 ETF has a slightly higher 0.2% expense ratio, it's still a pretty low cost ETF. And it's one that is definitely on my radar. I'm at least going to make a smaller investment in it just to kind of get it in my portfolio. And if big tech continues to outperform, then that's the one I'm going to continue to allocate capital to. So let me know what you think about that. I am going to buy that in a little while. I have to wait a few days till after I've talked about it before I can buy it. But I'm definitely going to do that. I'd love to know what you think. Leave me any comments or questions. I'll do my best to answer any of them individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.